Celsius users with crypto collateral stuck turned a bankruptcy process, Cryptoweast. Knitowski would get the Bitcoin back when he repaid the loan. But that's not what happened, because Celsius, which earlier in the year managed $12 billion in assets, spiraled into bankruptcy in July after a plunge in crypto prices caused an industry-wide liquidity crisis. Knitowski and thousands of other loan holders had more than $812 million in collateral locked on the platform, and bankruptcy records show Celsius failed to return collateral to borrowers even after they repaid their loans. Every aspect of what they did was wrong, Knitowski, who runs an Austin, Texas-based company called Phunware, said in an interview. They were provided with some level of optimism on Friday, after Celsius announced the sale of its asset custody platform called GK8 to Galaxy Digital. David Adler, a bankruptcy lawyer at McCarter & English who is representing Celsius creditors, said money from the transaction has to go to paying legal fees. Adler said he's representing a group of 75 borrowers who have approximately $100 million in digital assets on Celsius platform. If another company purchases the loans, customers would likely have a chance to repay them and then have their collateral released. Knitowski told CNBC he had elected to take out his loans at a 25% loan-to-value rate. That means if he took out a $25,000 loan, he would post 4 times that amount in collateral, or $100,000. The more collateral a borrower is willing to post, the lower the interest rate on the loan. If the borrower fails to repay the loan, the lender can seize the collateral and sell it to recoup the cost. It's just like a residential mortgage, for which the borrower uses a home as collateral. In the crypto world, a borrower can ask for a loan and pledge Bitcoin as collateral. Earlier this year, as the price of Bitcoin dropped, Knitowski paid off one of his Celsius loans to avoid getting margin called and having to increase his collateral. But after doing so, the company didn't return the Bitcoin that was serving as collateral for that loan. Imagine you pay off your car, but someone keeps it, Knitowski said. In this case, it would be like you pay off the loan. The crypto platform also failed to provide borrowers with a complete Federal Truth in Lending Act, TILA, disclosure, according to former employees in an email sent to customers on July 4th. The email to borrowers said, the disclosures required to be provided to you under the Federal Truth in Lending Act did not include one or more of the following, and then proceeded to list more than a dozen possible missing disclosures. A former Celsius employee, who asked to remain anonymous, told CNBC that the company was retroactively trying to come into compliance with TILA. You don't get to say, oh, oops, we forgot like 25 items in the Truth in Lending Act and, as a result, we're just going to redo them and pray, Knitowski said. Nunn, who lives in Dallas, said he got a loan to invest in more Bitcoin after seeing a promotion for the platform. Sam Bankman-Fried, the founder and CEO of the exchange, told his followers on Twitter that the company's assets were fine. While Celsius implosion doesn't carry the magnitude of FTX, which had been valued recently at $32 billion, company management has faced its share of criticism. According to a court filing in October, top executives took out millions of dollars in assets prior to the company halting withdrawals of customer funds. A former employee, who asked not to be named, said there was a lack of financial oversight that led to significant holes on the company's balance sheet. One of the biggest problems was that Celsius had a synthetic short, which occurs when a company's assets and liabilities don't correspond. The former employee told CNBC that when customers deposited crypto assets with Celsius, it was supposed to ensure those funds were available anytime a customer wanted to withdraw them. However, Celsius was taking customer deposits and lending them to risky platforms, so it didn't have the liquidity to return funds on demand. As a result, when customers wanted to withdraw funds, Celsius would scramble to purchase assets on the open market, often at a premium, the person said. He also said that Celsius was accumulating cryptocurrency tokens that had no value as collateral. The ex-employee said he left Celsius after discovering the company wasn't being prudent with customer funds and that it was making risky bets to continue generating the high yields it promised depositors.